Hello and thanks for checking out ChartGuys.com. We're proud to be one of the most successful technical analysis communities online, teaching you the skills to become a more confident, effective, and informed trader. Join our community of hundreds of analysts worldwide working together to learn the charts, generate profit, and achieve financial independence. For access to daily live chart analysis and market coverage, a thriving chat community, along with dozens of hours of exclusive educational materials. We look forward to seeing you. Let's check out some charts. Hey everyone, hope you're doing well. Going to check in on SPY and oil here. Those are the most important factors in my opinion. We'll actually also look at the individual sectors, the tech sector and the financial sector as well. Hope everybody's having a happy Christmas Eve and a Merry Christmas and happy holidays and all that good stuff. Still on the road myself, currently in a big empty hotel, but having a good time. So I am going to go over my game plan, and as always, I'm not a licensed financial advisor. This is me pointing out my plan, what I'm doing, not suggesting anybody do anything similar, because what I'm doing is high risk, and it is because I've had a really good year, as I explained in the last video. So what we have right now is a gap down open. I started to scale into my position. So if you did not see the last SPY video, go check that out. I highlighted my trade game plan going forward, and I said I was going to break it up into 4 positions. I entered 2 positions today. We closed at the low of the day. And if we see a gap down open on Wednesday, I'm going to add to those positions again. At this point, we have seen significant pullback with 8 big red days in a row. Today would have been a very high volume day. And just looking at the hourly time frame, we can see that the first 2 hours of trading was higher volume than the first 2 hours of trading of the last couple of days. And for that to happen on a half day on Christmas Eve is very unusual. So high volume is still certainly there, and a close at the low of the day is very notable, showing the weakness. So this is the trade style for me where I know I'm going to have to sit through a little bit of red. The only way that I'm not going to sit through red is if I just luck out and nail the bottom with partial positions, and then I would never get a full position because the bounce would get going without me getting a full order. So I love the psychology of where this trade game plan puts me in, because I entered today and then we saw a bounce play out and I was profitable, and I said, great, if we run from here, I make profit, all is good. But we didn't. We faded back to the low of the day. And I say, great, I have, half of my position still cash. I'm ready to keep adding here. And I'm looking for the oversold bounce to get going sometime at the end of this week. If not, then certainly early next week. So lots of things to be watching. Did a lot of driving today on the road for about 6 hours and had a lot of time to think. And I came up with an analogy. So my trade game plan right now, essentially what's happening is there's a house on fire. That's the market right now. When you drop this fast and this far from 269 to 234, that's a $35 drop in just about 8 days. That's a house on fire. Everybody's panicking, emotions are high, everybody is fearful. What you have happening is the entire town gathering around this burning building, and everybody's saying, oh man, that building's gonna go down, and there's a dog on the inside, and everybody's saying, don't go in for that dog, that house is gonna burn down, it's probably gonna spread to other houses. And then you have the extreme people, very emotional people, saying the whole world's about to burn, and those are people that think that the market's gonna collapse. But that's the spectrum, that's the environment that we're in right now. We hear it from talking heads, we hear it from social media. Everybody is bearish. We reach a point, just like everybody was bullish on the way up, we reach the opposite scenario where we reach extremes and everybody is bearish. Right now, if people are selling at this point, you are not smart money, in my opinion. This is not the time to be selling. If you have not sold at this point, you're selling a short-term bounce at the very least. But the bottom line is, everybody's looking at this house, everybody's fearful, everybody's negative about this burning down house. Then you have experienced traders and contrarian traders that know to go against the herd. If you follow the herd, you're never going to make it as a trader. You go against the herd. And right now, the entire herd, everybody in the town is fearful of this house fire. So I'm standing there looking at this house saying, I've seen houses burn down before, and I've run in and saved a couple dogs in the past. I've done this before. I can save that dog. I can run into this house right now. And everybody's telling me not to do it. And it's for newer traders who have never run into a burning house before to save a dog. It's extremely distressful and it's extremely frightening to think about actually going into that house. But the experienced trader who has done it many, many times does not have that same fear. So I know worst case scenario in this trade game plan that I've laid out and I'm currently in the process of executing, worst case scenario, I'm going to take a loss, and I'll take a calculated loss of maybe 5% of my portfolio, which I have already allocated as my risk tolerance for this trade, and I'm perfectly fine with that. So a newer trader is not used to taking losses. They're fearful. What if they die in the house? What if they don't make it? Things like that. So just be aware that that's exactly what's going on right now in terms of veteran traders looking around at the market right now and saying, this is the time to be buying when fear is at an absolute extreme and we see extreme levels. The daily RSI on SPY is currently down at 19. If we see another gap down open, that's going to be closing in on single digits. The weekly RSI on SPY at this point is oversold at 29. The 4-hour RSI is down at 15. The 12-hour RSI is down at 14. These are absolutely extreme levels, and I'm very comfortable with where I stand right now. Right now, I'm holding a red position, and I very, very rarely ever hold a red swing position. I'm a day trader, so for me to be holding a red swing position, normally something would be wrong. What went wrong with your trade? Why didn't you have a stop loss? But obviously, this is part of the game plan. I did not anticipate that the bounce would get nailed on my first day of entering, and I'm going to scale in another position on Wednesday, and if we have another red day on Thursday, I'm going to scale in another position on Thursday as well. I might diversify a little bit and not just go all SPXL, which is the 3 times leveraged bull for the S&P 500. I'll probably look at TQQQ as well. The financial sector has been a big weight on the S&P 500, and so to be able to avoid that entire sector and just look at tech and know that some bulls are going to be looking to buy Amazon and Apple at these discounted levels, then I want to have some exposure to a bounce opportunity that doesn't have financial sector as a factor. So I'm running into the burning house right now, and I'm perfectly fine doing so. Just be aware that, if you're doing that as well, you need to have the game plan established, and you need to be aware that it's going to be stressful. This is a very high-risk trade, high risk, high reward, and if the bounce gets going, that reward will come through. So one thing to note psychologically that's been going on the past 2 days is a couple quick bounce attempts. And we saw this first thing on Friday where we had 10 minutes where the price went from 246 up to 249. And that's almost a $4 move. That's essentially 1 to 1.5% of a bounce in 10 minutes. That bounce faded and got no follow through, and the bears continued the rest of the day. Today, we had a similar bounce. It lasted about a half an hour, 40 minutes, 236 essentially up to 240, another $4 bounce. Another 1.5% gain in a short amount of time that faded and was lost to lower lows. So essentially what I see the market doing there, and what I see the bulls doing, is testing the market. And they're saying, are we ready to bounce? And the bears saying, nope, we're not ready to bounce. We're still selling at this point and getting no follow through. But what that does is it sets up psychologically that bulls are now going to be sitting here and watching, and when the real bounce does get going, we're going to be looking at this. And a lot of bulls are going to say, oh, that's a solid bounce, and it happened very quickly, but these bounces have been fading, so I'm not going to get in. And when it is the bottom, we're going to be seeing a significant bounce of $4 or $5, brief consolidation, and then continuation. And by the time the cautious bulls realize this is the real bounce and our temporary bottom has been set, then they're already buying, $6 off of the bottom, which at this point will be multiple percent off the bottom. And that's where we get the FOMO feeling and the complete 180 turnaround of extreme fear to everybody saying, okay, that's our temporary bottom. The bounce is playing out now. Let's see if that V-shaped recovery can come. And the V-shaped recovery will come if the bulls realize this train's leaving without me. I wanted to play this bounce, and it's happening a lot quicker than I thought it would. So I see no red flags in my trade game plan right now. Red flags for me would have been bear flags. So if the hourly time frame today had seen some higher lows and higher highs with very little follow through, let's say we broke resistance and then saw a higher low and then broke resistance without a lot of follow through, the last thing I want to be seeing is bear flags. It cools off the RSI levels and it allows for continuation to the downside. We're going to look at oil in just a second, where the daily chart has given brief, very weak bounces that have allowed for more extreme longer term pullback because we're cooling things off. The reason that I have my trade game plan going on SPY right now is because it is a falling knife straight off of a cliff. If we were stair-stepping on the way down with weak bounces, I would be a lot less interested in this trade. I am interested in this trade because of how extreme everything is, with no relief for the bulls, with bears in complete control, and the bears are about to get greedy. And in my opinion, the bears are going to get slaughtered in the short term with just a quick bounce. And then I'll switch to looking for bearish entries, looking for just a daily lower high. So the bottom line is The bounce has obviously not started to take place. I'm still extremely interested in oil because I believe oil has to bounce for this market bounce to take place. And the trend changing on the hourly time frame is going to be notable on the S&P 500 for the first signal that, okay, this bounce is taking place and we are going to look for some follow through. But obviously that has not happened at this point. So at this point, oil is continuing to see weakness. This is the daily time frame. This is what I was talking about. So we saw the all-out dump and this is pretty much the falling knife comparable to what the S&P 500 is doing. Then a 4-day bounce. This is a bear flag without significant follow through. The bulls want to see a V-shaped bounce and want to see the price back up in the low 60s. Obviously, we didn't get that. That's a big red flag, and it has allowed for continuation down. Look how many bear flags we've seen. Weak bounce, sideways trading, continuation down, all-out dump today. If oil is dumping, any bounce in the S&P 500 is not going to be believable, in my opinion, and I am very confident that oil is going to mark the bottom with the S&P 500, the temporary bottom. And this is something that a lot of the talking heads are not talking about. They're talking about China and the trade war. They're talking about the Fed and rates. They're not talking about oil completely falling off a cliff. They've started to mention it a little bit, but it's not a main talking point like I believe it should be. In 3 months, we've gone from 76.88, and we have dropped down to 45% drop in 3 months with no bounce on the monthly time frame. The weekly time frame saw a 2-week bounce, but again, you drop 45%. The weekly RSI is down at 23, and we know an oversold bounce is coming in the near-term future. Historically, this is getting close to the most oversold levels we've seen in years. Now, we did see that one period back in 2015, 2014, 2015, which I want to talk about a bit. That's when the RSI got to absolutely absurd levels. But aside from that, this is one of the most extreme weekly RSI levels. So what I want to point out now is something that we pointed out back in February of 2016. And check out the video I made called Tweets Moving Trillions. And I talk about it with more detail, and I show specific tweets and timing of how things played out. Essentially what happened is you had oil pulling back from 107 to 43 on a straight dump. We then bounced and saw the oversold bounce play out, but then it led to further downside, and we ended up dropping about 75% on oil in just about a year and a half, closer to 2 years. So that was a huge drop in oil, obviously, and we're now seeing a huge drop in oil again. What was the S&P 500 doing at that point in time? Well, here's SPY back at that point in time. We had an all-out dump from 213 to 182. We dropped 15% in 2 weeks. A little bit less than that, 13% in 2 weeks. That was very notable. We then saw the market recover with a very significant bounce and then gave it all right back to test those lows again. So what was going on during that bounce? That bounce was September through November of 2015. And here on September through November of 2015, this is the bounce that was going on. So it wasn't a significant bounce on oil by any means, but it stopped the downside action for 2 months, and it allowed the S&P 500 to see a significant bounce. So we don't need to see oil bounce 10% in order for the market to bounce 10%. What we need to see is oil see a temporary bottom. And I'm not financially savvy for the fundamentals of oil. I know that, increase in production and high shale production in the U.S., these are all things that are leading to increased supply and prices going down in oil. I'm starting to look, fundamentally, what is going to be a short-term catalyst that could cause an oil bounce. I believe that oil is going to bounce 10 to 20% on the weekly time frame, and I believe that that's going to allow the S&P 500 to see a weekly oversold bounce as well, just to set lower highs. We're not going to change any trends on the S&P 500, nor am I looking to, but we're looking for relief in oil to allow for relief in the market. So what happened back then in 2016 is a tweet came out, and this is probably the most valuable tweet that the market has ever seen, because a tweet was put out right here, a double bottom to the penny on the S&P 500, and a reporter put it out again. Check out the video for the exact details, but he put out a tweet talking about an OPEC deal, and that marked the bottom of the S&P 500 and the bottom of oil. That was February 8th, 2016, and we look at February 8th, 2016. It's right here on oil at 26. Next thing you know, we bounce 100% in oil in just 3 months, a little bit more than that. Looks like about 4.5 months. 100% bounce in oil. So that tweet, fittingly enough, the title of the movie or the video I made is Tweets Moving Trillions, because that tweet allocated trillions of dollars in a complete reversal, and the S&P 500 after that double bottom, look at that face-ripping rally where we went from 181 to 211, a $30 move, and that is about 16% in 3 months. 16% bounce in the market in 3 months, coinciding with the bounce in oil. So that's why I'm saying now, in a very similar scenario where oil and the S&P 500 topped out at the same time, again, the all-time high for SPY was in September, October, and the high of this move on oil was in September, October, lining up exactly at that same point in time. So in my opinion, we need a fundamental catalyst for oil to bounce to allow for the S&P 500 to bounce as well. So keeping an eye out for that. We closed extremely weak at the low of the day on oil. Oil's hourly RSI is crushed. We have a monthly support approaching. 42.03 on oil is going to be tested to start next week. And here we are at this support, 39.17 and 42.03. The RSI levels, the weekly on oil, again, 23. The daily RSI is now oversold, down at 26. The 4-hour RSI is oversold, down at 23. You're noticing the pattern where we have extreme oversold levels in both oil and the equity market here. So in my opinion, if we get a market bounce and oil is not cooperating and bouncing as well, I'm going to be a lot more skeptical of that bounce. I want to see oil, SPY, and the financial sector all bounce at the same time for me to be a believer that this actual bounce is taking place. So at this point, like I said, I'm going to add on a red day on Wednesday, if we get it, to be looking for averaging down my cost base. And at this point, let's say that was the bottom, which I don't believe it is just yet, but let's say that 234.27 was our bottom. Just visually looking at where we could expect a bounce to. Again, like I said in the last video, I think a 5% bounce is going to be pretty easy for this market. I feel like that's a conservative bounce estimate. So for leverage 3 times ETF like SPXL that I am playing, that would be a 15% bounce, which is obviously very significant gains. I think the bounce could be more in line with, 7 to 8 to 9%, which would be 20+% on SPXL. It's also getting to the point in this market that I'm reaching out to friends, when I reach out to friends and only very clear setups for me, like I did in 2017 with the Canadian MJ market changing the trend. And I'm saying, hey, if I know you've got cash sitting in your account and you're younger like me in your 30s, and if you're looking to try and make a long-term entry in this market, now's the time to try and do it. And you can so very easily make an entry in SPY at these levels and wait for the bounce to take place and then set a stop loss at break even. And you have zero risk, and the potential is there, even if it's a 10% chance that, this is the bottom of the market and we're going to head back to all-time highs in 2019. I don't think that's likely. Let's say it's a 5% chance. Putting yourself in a risk-free scenario to potentially nail the bottom and start a significant recovery, why wouldn't you do that? So again, that's something that I'm, reaching out to some friends and being like, hey, it's time to start nibbling here and scaling into positions, and then just set a stop loss at break even once the bounce actually does get going. So those are my thoughts on the market going forward right now. That's what I'm watching the most. Let's check in on the financial sector. Again, just completely falling apart at this point. The weekly time frame has now pulled back in 3 weeks, 19% in the entire financial sector. So again, extreme RSI levels. The daily RSI is 18 on XLF. The 4-hour RSI is 15. The 12-hour RSI is 10. So I'm very confident that a short-term bounce is coming with these RSI levels. We look at the tech sector. It's extremely oversold. 4-hour RSI is 18. Daily RSI is getting oversold, now down to 25. And bottom line is, bounce is incoming. That's what I'm setting up my trade plan for. And again, more cautious traders are waiting for hourly trend changes. You're going to have less reward on the bounce, but you're going to eliminate a lot of risk, and you'll be getting in when the momentum has clearly shifted. Obviously, I'm fighting against the trend. I'm swimming upstream against the current, and I'm doing so knowingly, taking on more risk, looking for more reward on this trade. So I hope everybody is doing well. Hopefully not too much stress on longer term positions and 401ks heading into the holidays. That's the last thing we want to be thinking about, is money and the color red. I guess maybe a little bit of the color red, but you get what I'm saying. So it's important to zoom out and realize that yes, a short-term bounce will be coming. Whether or not we're going to continue to pull back for the next 2 years, nobody knows. but all we can do is look to protect ourselves, look to hedge, look to profit on the way down, and we'll continue checking back in as always. See you guys on, let's see, Wednesday after the market close, and it'll surely be interesting. Keep an eye on oil, financial sector, and the S&P 500, but oil and the S&P 500 are the most important for me in my opinion. Thanks again. See you soon.